Okay, so we changed the title as well. So now the title is What Firms Do, Gender Inequality in Linked Employer-Employee Data. And this is joint work with Alessandra Casarico at Bocconi University. Okay, so the gender pay gap has decreased remarkably in recent years. The median was around 14% in OECD countries in 2016, against a value above 30% in the 70s. The traditional explanations for the presence and persistence of gender gaps in pay are related to both demand side and supply side factors. So demand side factors are about, for example, taste or statistical discrimination, and supply side factor concern productivity differences due to human capital accumulation and work effort. However, these traditional explanations have decreased in importance in the literature, and nowadays there is a growing literature about the presence of differences in psychological traits or social norms. Of course, the gender wage gap depends not only on the characteristics of the individuals, but also on those of the firms that employ them. So, in a frictional labor market, firms offer or bargain different wage premiums, and these wage premiums may be different according to the gender of the worker. So there are two channels that open up that are related to firm-related gender wage inequality. A channel that is between firms, so women sorting into low-pay firms, and a channel that happens within firms, so women bargaining lower wage premia with respect to men. So in this paper, we focus precisely on the role of these firms' premia, and we are gonna estimate the contribution to the gender pay gap of this of these differences in firm wage premia, decomposing the impact of sorting of women into low-pay firms and bargaining power differences within firm. We're gonna have a look at what are the mechanisms that drive these two channels. In particular, we're gonna explain sorting as the outcome of a gender gap in mobility across different types of firms, and we're gonna try to see whether there is a relationship between the presence of women in the top of the firm hierarchy and the bargaining power of female workers. So we're gonna exploit the introduction of gender quotas in Italy in 2011. The contribution of this paper is that we're looking at the role of firms sorting and bargaining at the mean. This is in parentheses because it was already documented before. We're going to have a look also at what is the impact of these factors along the distribution of earnings and what is this contribution over time. Also, we're going to have a look at these gender differences in mobility across firms, and in particular, we're going to have a look at how less likely are women to end up in better firms, that is, firms that pay higher wage premia to all workers. So, and these gender differences in mobility are going to depend on the characteristics of workers and on the characteristics of firms, both the origin firm and the destination firm. Lastly, we're going to show the importance of the gender representation in corporate boards for the bargaining power of female workers. And this is a kind of a new result because usually there is little trickle-down effect of gender quotas in the literature, and instead we're going to find that there is a minimal impact on bargaining power of female workers, and in particular of newly hired female workers, and also on their skill level. Okay, so the data that we're going to use is the INPS data, so the social security data, where we have the universe of workers employed in the private sector in Italy, and the period cover is between 1995 and 2015. Actually, for the gender quota analysis, we're going to add 2016 and 2017 to have a sense of what is the medium-run effects of the gender quotas. So we have information on workers, their employment. Yes? It's a panel. It's a panel data, yes, yes. So we have the employment and wage history of workers and some of their personal characteristics, and we also have information on firms such that their location, the industry, the date of opening and closure. And we match balance sheet data from AIDA. And just to give you a sense of the sample sizes, we have approximately 130 million male observations, 80 million female observations, and employed by 1.6 million firms. Yes?
Do you have any information on productivity as well?
Yes, so basically we control 4 individual fixed effects in our empirical strategy, which should take into account productivity differences, or at least the skill ability level that is unobserved, but we don't have precise measures of productivity of workers. We don't know hours. We're going to have weekly wages. Yeah. So this is the evolution of the gender pay gap in Italy over the period of time considered. And what we are plotting here is coefficients of regression of Minserian type regressions on a male dummy, basically. So the line with circles is the raw gender pay gap, and we see that over time this raw gender pay gap is going down. So starting from a level above 20% in 1995 to a level just above 15% in 2015. And we see that as we include controls, so for example, including observable characteristics of workers. You're right? Yeah, it makes this effect sometimes, my presentation. Okay, so when we include controls or when we include sector effects, the gender pay gap is reduced a little, but there is a strong contribution of the inclusion of firm effects, which basically take into account of the fact that women tend to sort into worse establishments, worse firms. Okay, so how can we take into account of both between and within firm factors? We can do that by using a two-way fixed effects model a la AKM. Okay, so where we include both individual and firm fixed effects in a wage regression. So we're going to regress the log weekly wages of workers, worker I employed at firm J at time T, on this set of individual fixed effects, firm fixed effects, characteristics, and this is an error component. The key here is that we are doing this regression separately by gender. So we're going to identify firm, gender-specific firm effects. And this is key because we assume, or better, we can rationalize these firm effects in a model where they represent the share of rents that the firm bargain with workers. And we're going to assume that these firm effects are gender-specific because there is a gender-specific share of the surplus of firm J that is shared to their workers. So that's because, so it's a sort of rent-sharing component of wages. When we have the firm effects, we're going to decompose the difference in the male and female firm effects at the mean in this way. So this is the firm contribution to their gender pay gap, so the difference in male and female firm effects averaged across male and female observations. We're going to decompose it into two components. So a bargaining effect, which is the difference in male and female firm effects averaged across male observations, and a sorting effect, which is the difference between female firm effects averaged across male observations and female firm effects averaged across, averaged across male observations and female firm effects averaged across female observations. So this part here is telling you by how much the gender wage gap would change if women were to receive the same male premium at the same firms. And this component here is telling you by how much the gender wage gap would change if women were to be employed in the same firms as men. So this is a standard OHCA blinder decomposition, and as usual, we can perform OHCA decomposition in 2 ways. So the other way is measuring the bargaining effect by averaging across female observations, and the sorting effect by using male firm effects. I'm going to present the results with the first decomposition or with the average between the two. So this is the main table of results. The main contribution, so the contribution of firms to the gender pay gap, so the difference in firm wage premium, is around 30% of the average gender pay gap over the whole period of time considered. Approximately 2/3 of this decomposition is due to sorting of women into low-pay establishments, and 1/3 is due to bargaining power differences within establishments. And this is also what happens when we split our sample across different occupations. Yes? Yeah, so we include experience, tenure, a dummy for part-time workers, and sector dummies.
So no family.
We don't have family characteristics, unfortunately.
This affects women's choices, so it is a huge factor of self-selection in this sort of environment and whatever.
Yeah, I totally agree. The only thing I can say is that we have this measure of weekly wages that is adjusted for part-time workers, so at least we control a little for it. But of course, we cannot control for the selection into work. So for blue-collar and white-collar workers, sorting is the most important factor. But when we look at the top of the pay distribution, so at executive and managers and middle managers, bargaining is the most important factor. And one question is whether this result holds across the whole period of time considered, or whether there is a sort of evolution over time. So what we do is to rerun our model using periods of 6 years from 1995 to 2015. And what we find is that there is a reduction of the gender pay gap as the one that I documented before, but the difference in firm effects is more or less constant over time. What changes is the relative contribution of sorting and bargaining. So we start from the first sub-period where sorting explains the whole contribution of firms to the gender pay gap, and we end up with a situation where the two channels are more similar. How do you explain this? So there have been, over time in Italy, some reforms that incentivize the use of decentralized wage agreements. So if women have a lower bargaining power with respect to men, the increased role of differences in bargaining power in explaining the gender pay gap can be due to this decentralized setting. Yeah.
Maybe I missed it, but how did you rule out differences in productivity in this estimation?
No, here, so, I mean, the only thing here is, doesn't go, no, here. The only thing here is that when we estimate these firm effects, we are controlling also for the individual fixed effects. That's the only way I can think of controlling for productivity in this setting, for a proxy of productivity, okay? So this is the situation over time. Now, turning to the mechanisms, a gender mobility gap can be a mechanism behind sorting. Why is that? Because women tend to move less often than men and have lower wage growth, and this is documented in the literature. So are women also less likely to move to better firms, that is, firms that have higher firm effects, or better, that are into higher quartiles of the firm effect distribution? So we investigate this by running this probit model, where basically our dependent variable is a dummy variable that takes value 1 if the destination firm belongs to a higher quartile of the gender-specific firm effect distribution with respect to the origin firm. And the main coefficient of interest is going to be the female dummy here. This is the result. So this is indeed the case. Women are less likely to move up in the firm effect distribution by 3 percentage points with respect to men. We include a bunch of controls and sector and year fixed effects. And there is also a difference when we look at movements determined by firm closure, so let's say involuntary movements, and when we look at the individual choice movements, so more voluntary movements. And it is somewhat reassuring that when the movement is determined by the individual choice, this difference in the probability of moving up between men and women is lower. So what can explain this gender mobility gap? So of course there could be some channel for preference heterogeneity, such as risk aversion or different attitudes to compete between men and women, or also there could be a higher cost of effort for women to move up in the firm fixed effect distribution. There could be also a higher cost of mobility that is linked to the dispersion of firm effects of men and women. We find some evidence for the risk aversion channel because here what we do is to rerun our probit model, splitting firms according to the dispersion of wages, and we see that when women move from firms that have a low dispersion to a high dispersion of wages, the gap between the probabilities of moving up in the firm fixed effect distribution rises considerably with respect to the other scenarios. And actually, when the movement goes from a high dispersion firm to a low dispersion firm, women are more likely to move up in the firm fixed effect distribution. Yes? Dispersion is the dispersion of earnings. It's the within firm dispersion in earnings. So we Yes, I mean it's a sort of if you don't want to compete to get a higher wage, this is one proxy that we have to measure the risk aversion. It's of course a very dirty measure. I agree with you, but it's somewhat indicative that we find this difference between the two groups. And so I'm gonna go a bit fast because I want to present the results on the gender quotas. So the question here is, does the firm environment influence the bargaining power of workers? So firm environment is captured here by the share of women in top corporate boards, and we exploit the introduction of gender quotas in listed firms in 2011 to obtain an exogenous variation in this firm environment. So what we do, we run firm level regressions, so we collapse our data at the firm level, and we're gonna run two different specifications. One that is called the static canonical DID, where we basically consider only listed firms, and we compare the outcomes of listed firms before and after the renewal of the board of directors, after the reform, and an ex ante matched difference in difference between listed and non-listed companies. What we are going to estimate in both empirical strategy is a rent sharing coefficient, gamma G, which comes from this interaction term between the value added of the firm in the pre-reform period interacted with the treatment dummy. In this specification, with the treatment dummy and the post-reform dummy in the second specification. So gamma G is the main parameter of interest, and it measures the bargaining power of workers. What we find is that we find some results, some evidence of the higher bargaining power of female workers only when we look at the static canonical specification, so looking at listed firms only. We don't find the same result when we look at the matching procedure, but what I can tell you is that when we split the treatment according to how intense it was, so when we split the treatment according to the share of women that were on the board of directors before the reform came into force, we find that at least the higher share of women prevented the bargaining power of female workers to fall. And what we also find is that there is an increase in the skill composition of female workers. So again, here this is significant, this is marginally not significant. And here the skill composition is measured by the average worker effects estimated from the AKM previously. And what we see is that there is a general increase in this skill composition, which is significantly higher for female workers with respect to male workers. And again, same result here when we split the treatment by the intensity. So there is an increase in this skill composition for women that were mostly affected by the reform, so that had a lower share of women in the board of directors before the reform came into force. So just to wrap up, we find this contribution of firms, we find a gender mobility gap to better firms, and we find the first evidence of the impact of an exogenous increase in the share of board, in the share of female board directors on the bargaining power of women. And I'm done. Yes?
So I do have an alternative suggestion as to why women might be clustered in low-paid firms. And is it possible that women, in an attempt to move up in their careers, move sort of semi-sideways to walk round the glass ceiling, and therefore take a journey through a low-paid firm as a way of getting the higher status post, maybe to come back? Do you see any evidence of this?
So in the mobility analysis, you're saying?
I'm just wondering, an alternative suggestion might be that the low-paid firms give you an opportunity, a way to walk round the glass ceiling, because they're more likely
I
to
see.
risk on you doing those posts than they're high.
Yeah, I see, but then you shouldn't observe that like bargaining is increasing over time, because this is a measure of the within firm difference. No? So you should see a trade-off between sorting and bargaining. But still you observe sorting and you observe within firm differences. But it can be that in some sense there is a trade-off between I go to a low-pay firm, but at least I have more chances of doing a career in that firm. Yeah. Yeah, we could check this. I tried to find something about promotions, but there's nothing, especially because the data don't allow me to really go into detailed occupation categories. So I cannot really tell when there's a promotion or not. So, yeah. But thank you. Yes?
So how do you think about the bargaining power? So it's not individual trait in your setup, right?
Well, it's
firm-based thing.
how much, on average, firms share their surplus, their rents, with their workers.
So, but then you should see sorting, that women should go to firms which provide more bargaining power to women.
Sure. There can be some interaction effects. What you observe is that if you include a sort of interaction between sorting and bargaining, the sorting importance decreases a bit, but the bargaining importance remains the same. So there could be some interaction between sorting and bargaining, for sure. But it doesn't really change the results much.
Sorry, can I ask on the wage differential that exists within a firm, assuming it's transparent, of course, from the outside. You've been able to find it, but in quite a lot of cases one doesn't quite know. It's only recently that we realized what the pay reviews are telling us about differences in wages that can exist in firms. Does it make it less likely that, I can't remember what your answer was, I think someone's asked already, less likely that a woman will try to use bargaining power to move up, or more likely? I can't remember what your answer was.
No, my answer, probably this is related to the question about also the interrelation between sorting and bargaining. So the interaction between sorting and bargaining reduces a bit the sorting channel, but leaves unaltered the bargaining channel. So basically the within firm differences remains the same. But what you observe is that sorting is capturing a bit of this interaction between sorting and bargaining. Why is that? Because of course if I know that I have a lower bargaining power as a sort of ex ante condition, I will have lower outside options, basically. Okay?
Okay, thank you.
Thank you.